This is ShadowQuant, Stocks, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 13, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is anchoring itself at $754.95, but the foundation is cracking underneath the technology sector. While the broad index posts gains, the Nasdaq is failing to confirm the move, and semiconductor names are bleeding hard in pre-market trading. We are seeing a classic divergence. Big caps holding the line while the growth engine sputters. Looking ahead, the calendar is light on macro data, but heavy on corporate results. On Monday, July 13, investors are watching Arrow and Fast report. But the real focal point arrives tomorrow, Tuesday, July 14, when the Big Four banks take the stage. J.P. Morgan, Goldman Sachs, Bank of America, and Wells Fargo all report earnings. This cluster of financial results will set the tone for credit conditions and net interest margins heading into midweek.
And that Friday, July 17, marks monthly options expiration, a date that tends to amplify whatever directional bias the banks establish on Thursday.
Here is the snapshot as of 9:19 ET. SPY is up 0.43% to $754.95, hovering just beneath its 5-day high of $755.42. QQQ is trailing at $725.51, up only 0.31%, highlighting that tech is acting as a drag on the broader rally. The Dow is solid at $525.78, and the Russell 2000 is the outlier, down 0.42% to $295.99. Sector-wise, defensives are leading. The materials sector is up 1.25%, consumer staples is up 1.11%, and communication services is up 1.2%. Meanwhile, the technology sector is barely positive at 0.23%, and the healthcare sector is down 0.82%. The headline driver is a sharp rotation out of semiconductors. Micron is down 5.3%, Applied Materials is off 4%, and Lam Research is also down 4%, all gapping lower amid concerns over SK Hynix and AI valuation compression. Western Digital is also down 5.2% on analyst target adjustments. Let's unpack the sentiment behind this sell-off. Pulse. You're tracking fear and greed. What does the VIX tell us? It tells us the market is sleeping. The VIX is sitting at 15.3, which is deeply complacent given that we just saw a 5% gap down in Micron. Normally, a move that size ripples into the volatility index. Instead, we see a decoupling. The fear gauge is static, but the actual asset prices are falling. This suggests institutional players are absorbing the float quietly rather than panic selling.
I'd push back on calling that quiet absorption. A VIX of 15.3 in the face of a flattening 10-year, 2-year yield curve at just plus 35 basis points is a risk flag, not a comfort zone. You're missing the structural fragility. The fact that small caps like the Russell 2000 are down 0.42%, while the S&P holds steady means liquidity is drying up outside of the megacaps. That's not safety. That's a narrowing funnel waiting to snap shut.
So the concern is that the low volatility mask hides a liquidity squeeze in smaller names. CIPHER, does the fundamental data support this structural shift?
Absolutely. We are seeing a repricing of the AI infrastructure thesis. Micron at $927.30 and Applied Materials at $578.24 aren't just reacting to bad news. They are reacting to a compression in expected growth multiples. With CPI at 4.17% and core PCE at 3.41%. The Fed funds rate of 3.62% leaves no room for the hyper-growth multiples these chips previously commanded. Capital is fleeing high-duration tech to chase the cash flows in consumer staples and the energy sector, which are up over 1% today.
Let's dig into the specific mechanics of this divergence. First, let's look at SPY. It is at $754.95, touching resistance near $755.42. Grid, is this a breakout or a trap?
Technically, it looks like a potential double-top rejection. SPY is testing the July 10 high of $755.42, but QQQ is failing to confirm. QQQ is at $725.51, leaving a clear gap below its own intraday high of $726.39. When the leader of the index fails to make new highs while the average holds, it signals distribution. The immediate support is $751.71, the July 9 close. If we don't see volume breakthrough here, the path of least resistance is a retest of that pivot.
But Grid, you're focusing on the index level and ignoring the breadth. The sentiment for QQQ is strongly bullish at plus 0.64, while OPL is bearish at minus 0.21. This fragmentation means SPY's stability is artificial. It's being propped up by a handful of winners, while the rest of the Mag 7 is rotting. That's not a healthy breakout. It's a weighted average illusion.
Which brings me back to the QQQ divergence. That negative sentiment on OPL is mathematically dragging the Nasdaq down. Even if SPY holds $755.42, the QQQ structure is broken. Sellers are defending the $726.39 level aggressively. Until QQQ clears that, any SPY move upward is technically invalid.
That leads directly to the semiconductor weakness. Let's talk about Micron. It's down 5.3% to $927.30. Grid, what does the chart say about this level?
This is a break of structure. The gap down to $927.30 creates a new local floor, but it's wide. If this level fails, there is no defined technical support in the immediate 10-day history for MU. It opens the door to high volatility downside. The key is whether buyers step in to fill this gap. So far, the volume profile suggests sellers are in control.
And from a flow perspective, this isn't just technical. The headline about AMD's valuation at $900 billion is creating a fundamental anchor point. Investors are realizing that if AMD is the benchmark, Micron's current pricing doesn't fit the margin of safety anymore. They are selling the inventory exposure because the downstream demand signals from AMD and SK Hynix are conflicting. This is a fundamental re-rating, not just a technical break.
And let's remember the broader context. With IWM breaking below $296 and heading toward $293.62, the credit environment for these manufacturers is tightening. If the bank earnings on July 14 show tighter lending standards, MU's balance sheet refinancing costs could rise, putting further pressure on that $927.30 level. This isn't just a stock problem, it's a financing problem.
Now, let's look at the safe havens. Consumer staples is up 1.11% to $84.12. Why are investors running there? Because it's the only place left to hide. Look at the sentiment scores. OPL is bearish. NVDA is neutral. There are no clear bulls in the growth space right now. When you remove the growth narrative, you are left with staples and energy. The energy sector is up 0.47%, and consumer staples is up 1.11%. Retail traders and algorithms are piling into consumer staples because they offer defensive beta in a flattening yield curve environment.
It's a rotation into certainty. Consumer staples' 1.11% gain is backed by consistent dividend flows and less sensitivity to the CPI print of 4.17%. In a world where core PCE is sticky at 3.41%, companies that sell food and household goods have pricing power that tech giants currently lack. This is a flight to quality, not just fear.
Finally, let's look at the outlier, IWM. The Russell 2000 is down 0.42% to $295.99. Grid, you mentioned earlier that this is a break of support. What happens if it falls further?
The July 10 low is $293.62. IWM is currently at $295.99, so we have about a 24-cent buffer. If that support breaks, we open up the path to $290.68, which was the July 9 close. from a technical standpoint. A break below $293.62 confirms a trend reversal for small caps. It signals that liquidity is exiting the domestic economy entirely.
Which aligns with my earlier point on credit stress. Non-farm payrolls is only plus 57K, and unemployment is at 4.2%. Small caps rely heavily on floating rate debt. As the 10-year 2-year curve flattens to plus 35 basis points, their cost of capital rises disproportionately compared to large caps. The IWM weakness is the canary in the coal mine for the entire credit cycle. If IWM fails $293.62, it's not just a technical loss, it's a confirmation of economic slowing.
Connecting the dots here. Grid flagged the QQQ failure at $726.39, and CIPHER highlighted the fundamental re-rating in EMU. Together, they paint a picture where the AI trade is unwinding not just on sentiment, but on valuation mechanics. Pulse noted the defensive rotation into consumer staples, which SPECTER linked to credit tightness. The consensus data suggests that the broad market strength in SPY is being maintained by a handful of names while the underlying machinery, IWM, QQQ, and semis, is shedding weight.
To wrap up our pre-market analysis, the S&P 500 is holding at $754.95, but the breadth is weak. Semiconductors are gapping down, led by Micron at $927.30, while small caps like the Russell 2000 are testing critical support at $295.99. Volatility remains compressed at 15.3, but the divergence between defensive sectors and growth tech is widening. Tomorrow, we wait for bank earnings to see if credit conditions tighten further. Thanks for listening to the ShadowQuant Equities edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.